And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. We are at the Nasdaq market site today for the 40th anniversary of the Nasdaq 100 Index. Now, you probably know this tracks the 100 largest non-financial stocks on Nasdaq. 94 exchange-traded funds track the NDX, that's what we call the Nasdaq 100, in over 20 countries, including the Invesco Triple Qs. That is the 5th largest ETF in the United States. Let's talk with Nelson Griggs. He's the president of Nasdaq. He runs the place. And with Todd Sohn, head of ETFs for Strategas. Nelson, Nasdaq 100 is synonymous with tech, but today we have this big news story. This China firm, DeepSeek, reportedly launching an AI model at considerably less cost than the U.S. models. You're the keeper of the Nasdaq 100. Yeah. What does this mean for that? What does it mean for NVIDIA? What does it mean for Microsoft? What does it mean for the whole group?
Well, a couple things. I'll take a step back. So the Nasdaq 100, again, 40 years, averaging 14.25% compounded yearly returns. So it has a great long-term track record. It's 60% technology, 20% consumer, the rest healthcare and industrials. So it is a little more diversified than you would normally think. But if you do look at the news story of the day, there's a lot of companies that are attached to AI in the Nasdaq 100 for sure. So it is seen obviously a downturn today. But those companies are the innovators of the world. They're going to have to get through this moment. And I think you look at their track record, and they've got a great story of doing that. And we'll see how they all adapt.
Yeah, there's all this talk about lower capital expenditures. Isn't lower capital expenditures good for the AI story? I mean, lower capital expenditures make it more accessible and faster and easier for other companies to adopt AI. At least that's the way I would look at it. I mean,
it'll be a story to play out on an individual company basis, because some companies will certainly benefit from a lower cost of capital when they think about the R&D efforts, and others that are more directly in it will have to, again, they're innovative companies that we've seen them get through any sort of difficult times over the years. They've shown they can do that. So.
Todd, let me bring in you. I often go to you. You're my resident ETF guru on all things. The Nasdaq 100 is one of the most successful indexes of all time. Most people don't know it launched 40 years ago. The Triple Q Nasdaq 100 ETF launched in 1999. Prior to that, people ask me all the time, you really couldn't invest in the Nasdaq 100. You had Nasdaq 100 futures, right? But that wasn't easy for an average person to invest in. So essentially, QQQs launched in 1999, as I recall. There is an astonishing universe of products around the Nasdaq 100 ETFs, 94 of them, Nelson told us about earlier. Why is this product so successful? And it didn't just happen this year. This was not 2023. It's been successful for a long time. So
when you think about the Nasdaq 100, I would put it on the Mount Rushmore of indices, right? Performance and the ecosystem, the measurements of that. The performance has been fantastic, and now because it's been so successful, you have issuers out there in the ETF space wanting to take advantage of the ecosystem, right? Of the constituents involved in that. So I can get plain vanilla. I can get equal weight if I'm worried about concentration risk. I can go super concentrated now and just get the top of the Qs, or I can sell covered calls on it, right? There's so many different ways to get the power of this index, and as we always like to say, ETFs are about access, right? So the Qs gave you access to the Nasdaq 100, and now the ETF ecosystem gives you access to all these different strategies involving those constituents.
Go ahead, tout your product here. I mean, that's a very good introduction.
I think that's an amazing introduction, but we have an incredible team here that we are investing a lot more than ever, because it is a partnership. So companies come to us, firms come to us, whether it's Invesco, First Trust, great partners of ours, or we go to them and bring ideas, and that team helps construct all these wonderful products. And I think the demand we're seeing, obviously you saw heavy demand in retail, but now it's branching out into wealth channels, it's branching out into institutional insurance products, and as you mentioned earlier, Bob, global. So we still think we're in the pretty early inning years of what the index can become.
There is an astonishing amount of derivative products and leverage products around this. So I'm looking today at the biggest volume ETFs that are out there, and I see things like the ProShares Triple Q 3X. That means you get 3 times. If it's up 2 times, you get 6%, 2% you get 6%, and the ProShares Ultra Pro Short Triple Q, which is 3 times inverse here. Yeah. Both of them are among the heaviest volume ETFs. I think they're 1 and 2, and then maybe the semiconductor ETF. So there's just one simple product, leverage and inverse products, and there's dozens of others that are around them at this point.
I even think more impressive, right? So the Qs are a top 5 ETF in terms of assets. The mini QQQM, right, slightly cheaper version, is the 40th largest ETF, and it just came into existence less than a decade ago, maybe 5 years ago. So that just shows you how in demand this index is, right? So you can go for the liquidity vehicle that is triple Qs, or if you want, say, the more advisor-friendly option, QQQM. And then the leverage products just speak to how popular this is. People want exposure to this, especially if you get a market shakeout, kind of like what we're seeing today. I would guess tactical folks are going to start piling into the leverage long product at some point, especially once conditions really wash out within the market.
Yeah, so we also have the latest spin-off, the Invesco Top QQQ. This is sort of the largest names in the Nasdaq 100. The symbol is QBIG, folks. And of course, that didn't launch. That launched only a short while ago. On top of
that's part of this theme of super concentration, right? So you have single stock leverage ETFs, and now you have top of the index ETFs. And I think it is curious. Maybe we're going a little overboard in terms of skewing away from diversification. Maybe I want the healthcare and industrial exposure that the Qs offer, as opposed to saying go super overweight into that top 8 to 10 names. But again, it's all about access.
Where do you
convenience.
fall in? I know you're not an index strategist. You run Nasdaq, but this concentration story is an interesting question. I personally don't worry about it that much because if you have a broad index like a Nasdaq 100 or even an S&P 500, some stocks are going to be more valuable. That's the market talking. But is there risk here in having the top 10 S&P companies are 38% of the weight? Is there?
I think, as you said, it's the market talking, and I think if an investor said that's all I'm buying, there's going to be more inherent risk with that person's portfolio. But I think there's a lot of education in the marketplace today. If you look at go to Invesco's website or all the other providers we work with, they do an enormous amount of education. Yeah. So I think that's what the investors, they would not put these products in market if they were not in demand. So that's the first step, and then if they don't get the traction, they know to shut these things down. So I think there's it's individual call and making sure they're diversified, not a company saying let's go buy one.
And of course, people keep telling me we're only giving people what they want, Bob. So now we have these whole spate of single stock ETF products. And there's an NVIDIA leveraged ETF product. It's got huge volume today. There's Nasdaq leverage products, 100 leverage products. On days like today, that's an awful lot of stuff to move around here, and of course some of this is synthetic, but does any of this pose any systemic threat to the system? Remember what happened a few years ago with the volatility ETFs?
I don't know about systemic, because there's still a small slice of the overall ETF spectrum. Their usage rate is certainly climbing, right, in terms of the dollar volume, but the amount of dollars on brokers' books is microscopic compared to just, say, the actual QQQ or any of the other passive vanilla products that are out there. So I'm not terribly worried about it, but you might see a story here or there where a wrong bet was placed and a firm is going to struggle from now on. Right? They'll have to repair themselves.
What do you think the market leaders are going to be a couple of years from now? And again, I don't want to put you on the spot. I know you're not a tech analyst, but I'm going to give you a chance to talk about the Nasdaq, the junior ETFs, the QQQJ. Now, they launched this product about 4 years ago. I actually had you guys on at the time. That's the next gen 100 one. I call it the Nasdaq 200. It's essentially the 100 non-financial stocks that are next eligible for inclusion in the Nasdaq 100. So it's not the 100, it's the 100 to 200 that are out there. And what's interesting when you look at these is it's not just tech stocks, like United Airlines is the biggest holding, I think, and then there's Anlim Pharma, Tractor Supply, eBay is a big holding at this point. I guess people want to know what's the next NVIDIA out there, and I know it's hard to figure that out, but you try to do that here to a certain extent.
I think those are companies, if you go back and look at when Nasdaq 100 was started, the median market cap was $500 million. Today it's $76 billion. So I think you look at the size of the companies that are in the next 100, they're still very large companies. So I think investors kind of want to know what is next. So next gen, I think we look at companies that are on a growth path, and what is next? That's anyone's guess. But obviously, who's taking advantage of the latest technologies? I think I mentioned before the R&D. If you look at just dollar percentage, it goes for the Q spend is just enormous. So these are up and coming companies. Not up and coming.
You also got to cover it in terms of rotation too, because people are worried about so this tech is too much out there. There's actually a Nasdaq 100 equal weighted ETF that's out there. They got everything, folks. QQEW is the Nasdaq 100 equal weight. So it weights all 100 of them on an equal weight basis there. And well, that's still heavy tech concentration even there, but it certainly spreads it out more.
Just it's going to be spread out the holding. The amount that's held. So,
but the money in that is much smaller though.
It's a way to dial back concentration risk. And it's probably working out today, I'd say. Equal weight indices are having a better day just because NVIDIA took a hit right off of the AI news.
Yeah. I want to ask you about the ETF market while we have you here. We don't get Nelson here that often, so I want to pick your brains. This is one of the many things in your portfolio is to make sure the Nasdaq ETF business continues to do well. It seems to me there's two big trends here. One is the cryptocurrency trend. The cryptocurrency ETFs, biggest, I mean, I don't know if it's the most successful launch ever, but 150 billion in assets in 1 year is pretty darn good. You have IBIT, which is the biggest one out there, is lists on Nasdaq, right? The BlackRock ETF. Give us some riff on that, if you will. And then the other trend I see is sort of option-based ETFs in general. But talk about crypto first.
You know, we're still obviously big proponents of the active market, so I think there's still a lot more money in active assets, but more new money going into ETF assets. That's very clear. 2 out of every $3 is moving in that direction. So we just continue to see demand for ETFs being built by Nasdaq. It's not just Nasdaq though. There's other big providers out there. So I just think we are continuing to see this trend of passive, but you need to have active to marry that so you don't end up being too concentrated just in active. So I think we're in a unique moment in time to say how does active continue to have a role. So you do have moments like a whole sector gets developed around something like digital or crypto, and now potentially having more clarity on the rules of what it actually is going to be.
Do you anticipate we will? I mean, we keep waiting for this grand piece of legislation for years now. That it seems more real now, the possibility.
It feels as real as ever. So just being over at the World Economic Forum, there's a lot of the players in the digital space, but then you start getting into talk of the institutional side, the banks saying, well, if there's rule clarity, we're going to be more active in the space. So I think it certainly feels like to us the mandate from the top saying there's going to be more clarity is coming, and we'll see.
And of course, this means if this happens, a whole build out of the crypto universe, like a build out we're seeing of the equity universe.
I think that's already happening based on some of the recent filings we've seen, and
Solana's coming. And heaven knows how many other coins are coming.
So I think the interesting thing will be, you have Bitcoin is to crypto as the QQQ. Right, is to technology type stocks. And I think that's always how it's going to be. Bitcoin will be the biggest, the Qs will be the biggest, and then you're going to get all these supplementary products there that some of them will make a living for issuers and some will disappear over time because they weren't as successful. So the performance is not good.
And the other part here, other than crypto, is the options, a continuing explosion of the options business. Where does that ever end? I mean, a lot of this really picked up during COVID when all of a sudden younger people, it seems, staying at home, decided to learn about how to trade options, and they seem to have a taste for this.
Yeah, well, it's depending on the kind of option, it could be casino-esque, right? You're living by 24 hours, or you can actually use options to create a sophisticated risk-managed strategy, whether you want to sell calls, buy puts, whatever it might be, and that's all wrapped up into ETFs now. And so with crypto, you can now build out a risk management and say, all right, I want to gain some upside, but I would like income, so I'm going to buy a covered call crypto ETF, right? Just to limit any volatility and keep the weekly or monthly income streams coming. So this is all sort of important stuff that's going to keep happening via NASDAQ.
Yeah. I want to ask you about the IPO market. This is another one of Nelson's pieces of the portfolio that you have to manage on top of ETFs. You also manage a substantial IPO business here at the NASDAQ. We've had 3 subpar years. I've been covering IPOs since 1997, so 27 years. I don't remember a worse 3 years in terms of total amount of capital raised. It was below 50 billion again for 3 years.
You can't because there hasn't been.
Yeah, I don't think there has been. Give me a reason to be optimistic in 2025.
Sure. I think you look at starting from 23 was probably one of the worst years we've had in a long time. 24 was just a bit better, and at the same time you had an amazing market backdrop with strong index performances, right? But it was pretty heavily weighted, but started to broaden out last year near the end of the year, and the deals went out did very well. So we have a track record now, and 25. If you look at 3 straight years of having limited capital raised in the public markets, there's certainly an enormous pipeline, and I think it's going to be another kind of going from a really tough 23. A better 24, now a good 25, not a floodgates, but I do think we're seeing things really start to pick up more the back half of the year. But even the first half of the year, we're starting to see some activity already.
How do you deal with this private equity problem? I don't mean from the ETF point of view. I'm just mean we've got so many tech companies that seem to be very happy sitting there, get funding to stay private. What will get them incentivized to go public? I hear this endless whining. Well, there's too many regulations. We don't need to go public. And number 2, we're getting a ton of money.
Yeah.
You know, look what happened to Databricks. They basically just said we've just raised a whole bunch of new money. They don't look like they're going public anytime soon. And that was a big candidate. How do we get people, these companies, incentivized to go public?
And there is a massive, I guess, convergence of public and private, because even in the private space, you can now have access to more liquidity. But if you want deep, sustained liquidity, you need to go public. So at some point, you know, companies do have on the roadmap to go public. And I always kind of say the pendulum can kind of swing one way or the other. It has swung to privates, but as you know, you look at just the markets kind of coming back, deals start doing better, valuation discounts kind of compress a bit, then the public markets get healthy again. So I don't think we're in this sustained, hey, this has changed forever, but certainly we do see more activity in the private space than we have and more innovation there too, in terms of how companies can get liquidity, how they raise money. So I do think, you know, we have to look at how do you broaden access to the private markets is probably your next big trend. Private wealth, those other areas.
So we see this already. We look at the ETF industry tying itself into pretzels, trying to figure out how to access private equity and private credit. We've seen some deals out there being floated that are a little bit on the questionable side about how are you going to have a fundamentally illiquid product trade in an ETF wrapper. Are they going to be able to crack this nut? Do we even want them to crack this nut?
I'm not terribly sure you do without further build out of private secondary markets until you can get clearer information on what the value of a company is, what the price of it is. I can go on the internet right now, I can get 5 different quotes on a specific private company, and I don't think that's acceptable. And the dispersion, what I mean, is extreme, right? If they're tightly knit in terms of the bid and ask, fine. But when I start to see $20 type differences, that's not exactly the most helpful thing.
Nasdaq runs one of the most successful private markets operations out there.
It's transparency, it's data, and then more efficient ways using technology to get liquidity. So I think we're still in the early days of that, but it is certainly, if you go back, I don't know, 7-8 years ago when it started to develop, it has certainly come a long way. It's you know,
but you know what I'm saying. I mean, I know you run Nasdaq and you're a business guy, but I'm a public markets guy. Isn't it better for companies to be public than them getting squeezed into these private markets and all of our viewers trying to figure out how do I get in on this because I'm not a qualified investor or whatever. I'm not. I mean, that's what frustrates me. I want more companies to be public. In the 90s, we had companies going public that they argued were too young and they were too volatile. Now we have companies that are geriatric, that are out there, that have been 15 years sitting there, private, and they come public, and they're already middle-aged companies. That's the other side. That's worse than going too young.
Yeah, we're on the same page here. We love to see companies go public more often. We'd like to see them look at the public markets as an opportunity to truly thrive. I do think when you think about the regulatory pendulum, it has swung a bit too far in terms of over-regulatory aspects of the public marketplace, and there's an opportunity now to say what are things around proxy access, the proxy process, the different rules that come out of the SEC. Can that be done in a framework that still protects investors, yet doesn't overburden companies? So I think that's an opportunity, and you know, we're very hopeful that this is a moment in time to do that, and we advocate for companies all the time at Nasdaq to do that.
Let's hope it is. Let's hope finally we start seeing some of these companies come out. It may be we need to have interest rates go up. It may be that some of them just need to, some of these private equity and other companies that are funding them need to say no more money. That may get them going. I don't know. All I know is I want to see more companies go public, and of course here at the Nasdaq. Thank you for inviting me and hosting me.
Amazing to have you here, Bob.
Really appreciate it.
Great to have you.
Thank you. It's been a long time here. That does it for this week's ETF Edge. My thanks to Nelson and to Todd. Now, we've asked Todd to stick around and provide us a broader perspective on the trends in ETFs this year and on the IPO market as well. That's going to come up on the ETF Edge podcast. And remember, you can still see all of our shows. It's on our website, all of them, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.